This is Bloomberg Intelligence.
We're really getting into now the streaming's arms race.
Dish is looking at that and saying we can really build a nice niche for ourselves.
In-depth research and data on 2,000 companies and 130 industries.
The dollar is the dominant concept in the planet.
I think the acquisition is a natural progression of what Microsoft can do with this technology going forward.
Bloomberg Intelligence with Alix Steele and Paul Sweeney on Bloomberg Radio.
I'm Alix Steele. Paul Sweeney is out this week, sunning himself somewhere in the Caribbean. So today, Bloomberg Intelligence show, I am going to dig inside the big business stories impacting Wall Street and the global markets. Each and every week, we're going to provide in-depth research and data on some of the 2,000 companies and 130 industries our analysts cover worldwide. Today, we take a look at big banks. After reporting earnings, what can we expect to see out of the Wall Street for the next 24 months? And plus, Disney may be getting its mojo back. We're going to explain. But first, we head to Europe and get BI's top predictions for Europe in 2024. And for more, we're joined now by senior energy analyst Will Hares. Oh, wait, Will, we're talking broad Europe, but let's really just talk about energy. What's going to be up with large integrated European energy companies this year?
Thanks, Alex. So we think that the long-term energy transition targets for these European majors will remain intact. These are, of course, led by ambitious renewable power capacity ambitions. So we think this group will increase this renewable power by at least a quarter this year, or roughly 5 gigawatts of their portfolio. This is likely to remain heavily weighted to solar versus wind, particularly given the cost inflation and some of the supply chain constraints we've seen faced by offshore wind in the U.S. in the past year.
But I thought that shareholders didn't like the whole huge push into renewables for some of these big integrated energy companies.
So that's true. We have seen some of the energy transition paces for these companies being dialed back slightly, but that's mostly being seen on the oil and gas side. So we're seeing higher investment in oil and gas, but as I mentioned, these long-term energy transition targets remain intact, and they're moving ahead with big additions, particularly in renewable power.
Do shareholders want that to happen, though? Are they rewarding them for those promises for this year?
Well, so it's a good question, and this sort of really gets to the heart of the issue that particularly European energy majors face, and they are somewhat fence-sitting at the moment between trying to placate a much more ESG-friendly investor scene over in Europe and against a much more returns-focused investor scene in the U.S. So some might say that they're trying to please everyone and also no one at the same time.
Exactly.
And particularly when you look at some of the valuation gaps between the European energy majors and their American peers, Exxon and Chevron, it's pretty easy to say what has been the correct strategy thus far in the energy transition, and that would be the much more business-as-usual, oil-weighted focus of Exxon and Chevron.
That's going to be their focus for 2024, right? So it's kind of a show-me story. They got to get the returns on alternative up. They're still investing, maybe at a slower pace than they were, but they're still investing. When's the turning point, either for when these companies really become sort of all-in energy companies versus just, say, an oil and gas company? And when do the returns start to really make a run for it? Is it 2025, 2026?
I think the returns are much longer than in the next couple of years. While we flag significant addition in renewable capacity coming this year and next year, for the renewables market is ripping. We need to put it into context versus how large the traditional and conventional oil and gas businesses of these companies are. Mm-hmm. Renewables still makes up just a slither of earnings for these companies, and it's going to take a long time for these portfolios to very gradually evolve from heavily oil weighted to gas weighted, and very eventually powered from renewables weighted.
Specifically, just to zero in 1 sec on BP, because they're in like an extra special, unique situation also, and that's sort of the changing of the guard of CEOs. Who's going to get it? And what does that tell you about their role in this energy transition? Because Bernard Looney had been pounding the pavement for almost 4 years on the alternative energy transition, et cetera. And then when he left, it seemed like they were going to slow the divestment of money into oil and gas. They were going to invest in less slow of a pace.
So BP has actually just very recently announced that their interim CEO, who is Murray Auchincloss, who was the prior CFO of BP, will be taking the leadership role in a permanent capacity. This corroborates our long-standing view. We had been saying this for many months. As he had sort of been the establishment candidate, we think this, most importantly, enables the company to put this leadership uncertainty behind it. He's also a BP veteran. It is highly unlikely to deviate on the strategy and is well known and well liked amongst investors. But still, as you were suggesting, he faces a very full inbox here, and most notably, including the challenge to address BP's heavy underperformance versus not only its European peers, but its steep underperformance from its American peers as well. And of course, navigating the company through the energy transition. Once again, finding that correct balance between much higher returned oil and gas projects and much lower return, but more acceptable to a European ESG friendly investor backdrop.
Yeah, I definitely don't envy that job right now. Hey, Will, thanks a lot. Always great to get your perspective. Will Hares, Bloomberg Intelligence Senior Energy Analyst. We continue looking ahead to the rest of 2024 and want to focus on global solar energy. Let's get to the man behind this, Rob Barnett, a Bloomberg Intelligence Senior Clean Energy Analyst. All right, Rob, what's the setup for solar in 2024?
Yeah, so I think the first thing to note is we've had a really banner 2023. The final year-end tally's not in yet, but global solar installations increased by more than 60%. If you're looking at Bloomberg NES numbers, I think they're showing a 64% increase, and the IEA showed a 63 to 76% increase last year. So we'll get the final numbers really soon. But I think the really interesting thing is that fundamental demand grew off the charts last year. But for most companies, we were looking at roughly flat revenue. And that's because module prices declined a very extreme amount as well. So when you look into 2024, I think we're going to see pretty robust set of fundamental demand numbers. And we're probably not going to see as big of a decline in module costs, which sets you up for a pretty good revenue growth story for many of the solar companies into 2024.
Okay, so the demand is there. Their costs won't be rising maybe as much, and their what they can charge will actually change as well. What's the worry spot for you?
Interest rates are still a problem just across the board for many players in the energy industry, and particularly in the rooftop solar segment. Most solar systems are financed, so higher rates are a headwind against this sort of broad energy transition trend that we've seen out there. I think at the end of the day, the new subsidies from the Inflation Reduction Act and other policies out there around the globe weigh what we're going to see on interest rates, but I think interest rates are still a phenomena that could win the day. So it's a risk to keep an eye on.
Is that because if I want to put solar panels on my house, to get that finance is too expensive? Or is it because the solar company that needs to, say, get more debt to build the stuff, that part gets too expensive?
So I think financing is available if you're a credit-worthy customer, but the problem is that we doubled interest rates over the last couple of years. And so it just, your cost of doing solar on your roof is higher given the higher interest rate structure. The module prices have come down, but not enough to overcompensate for the rise in interest rates.
How are these guys trading?
Yeah, very interesting question. I think the market is trying to get its head around whether the solar space is kind of a boring industrial type of entity or whether they're sort of growth names. So if you look at a company like First Solar, one of the largest players in the U.S., they're trading at a 7x EV/EBITDA multiple right now. The median company in our solar global peer group is about 10x, and the world market's closer to 11x. So right now, most solar names are trading at a discount to the broader market. And I guess the question would be, are they growth names or are they boring industrial names that do often trade at a discount?
What are they? What should they be? Because that's a great point. Like industrial or growth?
I think we are going to see some pretty great set of growth numbers for certain companies, particularly if you're protected by the Inflation Reduction Act or incentivized by the Inflation Reduction Act. So First Solar is trading at, as we come back to them, they're trading at that 7x EV/EBITDA multiple, but they're probably going to grow their revenue north of 30% this year. So a number of these companies, particularly where you're getting the demand boost from the Inflation Reduction Act, are poised to grow pretty rapidly this year.
Okay, so to that point, if we get a Republican in the White House, does that part go away?
I love the question. I kind of think of it along the lines of Obamacare. Republicans have been running against Obamacare. They haven't repealed it. I do think you're likely to see repeal of the Inflation Reduction Act as a campaign issue, but then the question is whether Congress will actually take steps to roll them back or make a big change there. And I'd be skeptical of that. My gut instinct is that it's pretty safe from a political perspective, but I do think we're going to see a lot of headlines about it this year.
Hey, Rob, great stuff. Love catching up with you. Rob Barnett, Bloomberg Intelligence Senior Clean Energy Analyst. All right, coming up, as pressure on the TV business mounts and media deal chatter heats up everywhere, Disney's starting to stand out. We will explain. You're listening to Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies and 130 industries. You can access Bloomberg Intelligence through BI Go on the terminal. I'm Alix Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch us Saturdays at noon Eastern on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app, or listen on demand wherever you get your podcasts.
Apparently, guys, Disney is getting its mojo back in 2024. Let's get the details. We're joined now by Bloomberg Intelligence Senior Media Analyst Geetha Ranganathan. Really? It's mojo? How come?
Okay. Yeah, I know why you would be skeptical. So there are, and rightly so. So there are a lot of uncertainties in the media sector right now, and there have been for a while. So you have this whole state of, ad recession, you have cord cutting, you have streaming, the streaming wars, and, the lack of profitability. But as we kind of look through all of that, we still think, Disney is in a good position. It stands out because it has best-in-class assets. They've embarked on a very ambitious cost savings program. They are making progress on streaming profitability, which we think will start to show by the end of fiscal 2024. And their parks business has been a real standout. And more than anything, they have scale. And generally, in difficult circumstances like these, I think larger players with more content and better balance sheets ultimately have more options to win.
What about their actual, because there's different ways to get into that. Then let's just talk straight up about their content in terms of their content spend and the quality of their content. How important is that part?
It's very important. They do have, the best entertainment franchises out there. Having said that, though...
Yeah, but how many times can you remake Star Wars? You know what I mean?
Yeah, no, that's exactly it. And so they've run into a little bit of a wall, especially on the studio side. So we've seen them, with a whole string of, miss hits, if you could call them that, at least on the studio side. And so they're in the process right now of kind of rejiggering the studio, kind of reinvigorating the content pipeline. And they're doing it in, I think, a very, very thoughtful and methodical way. So they're cutting costs. So, we were previously in this era where everybody was greenlighting, anything and everything. Of course, we're right now in a whole new kind of era of content cost rationalization and a lot of cost discipline. And Disney, of course, is kind of leading the charge there. So they've really kind of trimmed down their programming budgets. It used to be upwards of $30 billion. This year, they're going to get it down to $25 billion. So I think that's a fairly sizable savings. And remember, off that, you have almost $10 billion that will just be spent on sports costs, so sports rights. So there's not a whole lot that can be done there. But on the rest that they can control, I think they're going to try and do a really, really good job. So content absolutely is important. I think content is a key differentiator for all of these different platforms and definitely for Disney as well. And I think we're going to see them, definitely do better as kind of the months unfold.
Yeah, and that's why one of her notes, it's the light at the end of the streaming tunnel. And that's kind of what you're talking about. They're going to spend less. Some is fixed like sports, but they're going to spend less and it's going to come more into balance. What about areas that's not media, like their theme parks, for example, that goes much more the way of the economy?
Oh, absolutely. So what we've seen after the pandemic is the theme parks have actually kind of rebounded very, very strongly. Mm-hmm. So we're seeing attendance that's way ahead of pre-pandemic levels, but more importantly, because of all the efficiencies that they kind of put in place when the parks were closed through COVID-19, it's really kind of bearing fruit right now. And so we're seeing park margins. I mean, park margins used to be close to about 18 to 20%. We are seeing domestic park margins at about 27 to close to almost 30% sometimes. So it is really, really kind of driving profits. You know, back in the day, Alex, so just about 4 years ago, the entire theme park business for Disney made up roughly about 35 to 40% of profits. In 2023, it was 70% of profits. So this is really the bread and butter for Disney. And they know that, and they're investing $60 billion in their parks over the next 10 years because they know that this is where the growth is going to come.
Right, and also, unlike streaming content, they're not competing with like a zillion other streamers, right? Like
exactly.
Like, okay, maybe there's like the Harry Potter, like whatever in Florida, but that's very different. So then what? And is this going to get sort of shareholders off Disney's back?
I think it will. Unfortunately, right now, Disney is caught between a rock and a hard place. There's just way too much of, focus on the media assets. And the media assets are the one part of the business that's not performing well. So they have to come up with some kind of strategy, whether it's outlining a new digital strategy for ESPN, whether they can kind of forge some new partnerships, or whether they can do anything with kind of their TV assets, maybe the ABC network, or maybe some other, Disney linear network channels. We'll have to see, but, that is kind of really what is really weighing on the stock right now.
Free cash flow. Talk me through it.
Free cash flow. If there was anything that you took away from the last earnings call, it was free cash flow. They guided to something like a 60% increase in free cash flow for 2024. And I think that really gave investors quite a bit of cheer. Before everything, so before this whole foray into streaming, before Fox, Disney was producing something like about $10 billion in free cash flow. That went down to about $1 billion in 2022. So, obviously streaming took a huge bite out of free cash flow. Obviously, we have CapEx, all of those different things. But now we're kind of back on track. So $8 billion 2024, and expect that to go higher and higher.
So this is the year. Like, this is the year when all the stars start to align, basically.
Definitely on the financial side, I definitely think so. And if you can kind of, not just free cash flow, but if you're also then kind of looking at profitability and EPS, I mean, this is the one media company out there that is giving you double-digit EPS growth. And that's really hard to get in media right now.
How undervalued, then, is Disney?
That's a loaded question, right? If you kind of look at just the streaming business alone, so Netflix right now is trading something like at about 25 times EBITDA. Disney is less than half of that, right? So one could argue that, once their streaming business starts to kind of hit profitability, obviously they should re-rate. The other side is really the theme park business. I mean, this company is trading like a TV networks company, and it shouldn't really be doing that, right? It should either trade like a leisure company, which typically trades at, low double-digit multiples, or even up to the mid-teens, or it should trade like a streaming company, and it's doing neither. So it is definitely undervalued.
I appreciate that this might be the year where that turns, but the sentiment needs to sort of realign. And I'm wondering, do we need to see peak streaming, and also what would that even look like, for the sentiment to really turn?
Yeah, I think once we kind of see Disney kind of hit some type of profitability metric, so they have definitely made a lot of strides as far as profitability is concerned, at least in terms of reducing losses. So they were losing about $4 billion in 2022. They lost $2.5 billion in 2023. And the idea is that it's going to be much, much smaller this year. But once we kind of get to that path where the street can model out, I mean, right now we're thinking that, the street is modeling in fiscal 2025 about $1 billion in streaming profit. I actually think that it's going to be way, way higher because they have a lot of, monetization levers that they can pull, whether it's increasing prices, whether it's the new ad tier, whether it's integrating Hulu into Disney Plus. I mean, all of that is going to lead not just to revenue synergies, but also cost synergies. And so I think, that $1 billion should actually be much higher at about $2-3 billion. But once, investors can kind of catch on to that, then I think we can kind of see that sentiment finally start to turn.
I guess what I also mean, too, are the days of content providers just spending boatloads of money and delaying profitability or returning meager profits, is that legit done?
It is.
So even for like a Netflix, even for all the guys?
Absolutely. I mean, Netflix is the only company that's actually making a boatload of profit right now, but everybody is laser focused on that. So it's just a matter of time before the ones that can actually make it will get to profitability, or the other ones who can't will just have to kind of quit.
Quit? What would that?
Yeah.
What is that?
Yeah, you have to put
How?
up or
What do you
shut
do?
up.
You can't quit now if you pumped all that money into it.
Well, I mean, that's the whole thing, right? You have all of these smaller players, whether it's a Paramount Plus or an AMC Plus. I mean, at some point there has to be a shakeout, right? Disney obviously does not fall into that category, but the smaller players, I think, eventually at some point just have to call it quits if it's not working out.
Right, and I can't imagine like Apple or Netflix or Disney opening up their pockets to buy something. Like, shareholders would not dig that, right?
Yeah, not at the moment.
Yeah. Okay. Hey, Geetha, always fun to catch up with you. Geetha Ranganathan, a Bloomberg Intelligence senior media analyst. Coming up on the program, we're going to head to Wall Street and take a look at financial stability of the big banks. You are listening to Bloomberg Intelligence on Bloomberg Radio. I'm Alix Steele, and this is Bloomberg.
You're listening to the Bloomberg Intelligence Podcast. Catch the program Saturdays at noon Eastern on Bloomberg Radio, the TuneIn app, Bloomberg.com, and the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Policy risk. For the U.S., large investment banks like J.P. Morgan, Goldman, Bank of America, Citigroup are increasing overall as U.S. banking regulators pursue a proposal known as Basel III Endgame. To me, it sounds like a Marvel movie, but whatever. That result will be a lot of capital requirements rising as much as 19% for some of these lenders. Let's join now by Bloomberg Intelligence senior government analyst Nathan Dean. Nathan, the CEOs will complain about this no matter where they are or what they're doing. What actually is Basel III Endgame?
So, and the reason why this is called the Endgame is that this is actually the last remaining proposal of the Basel III Accords. In Europe, it's known as Basel IV, but here in the States, we call it the Basel III Endgame. And what this proposal does is, like you mentioned, it raises capital requirements by 19% by doing a recalibration of risk weighting of assets. And there's really three pillars to this. It's operational risk, market risk, and credit risk. Now, the banks will say, look, we don't think this recalibration is needed. It's unnecessary, especially in a time of economic uncertainty. And they also will say that the Federal Reserve, the OCC, and the FDIC have not followed what's known as the Administrative Procedures Act, the law that requires regulators to follow a certain process. Now, the comment deadline for this was on January 16th. We read over 1,000 pages of comment letters, all of them saying that there was a problem with this rule, but we still think that there's a 60% chance that the regulators are going to finalize this year, and they're actually aiming for June. That is insanely fast for a rulemaking of this size, but we also wouldn't be surprised if this gets pushed off to 2025 because of the threat of legal action.
Why do they hate it so much? Other than the fact that they're going to have to set aside more money. What's the real issue?
So, obviously you have this idea of higher capital requirements in an area where banks have somewhat been safe. I mean, one of the arguments is we saw regional bank turmoil in 2023, and there was really no spread to the other system. But really what it comes down to is, I think, what's called the credit risk and the operational risk provisions. So on the credit risk side, you've got risk weighting of assets for things like consumer loans, credit cards, mortgages. And because the banks have to set aside more capital to offset this, their complaint is, look, we're just going to do less of it. You want to get the mortgage market moving? Well, if you're asking us to hold more money as for part of these weighting of mortgages, well, then we're going to do less of it. And then the other aspect is this operational risk. And, the operational risk essentially states that instead of using your own internal models to calculate this risk, you have to use a standardized method. And the standardized method includes a lot of what-if scenarios that may not ever actually happen. And look, the banks the banks will already hold capital for this rainy day event, if you will. I mean, they will argue that they do it via the G-SIB surcharge and through stress testing and so forth, but they don't like the idea of holding capital for this what-if scenario, especially when their peers in Europe and the United Kingdom are holding much less. In the Americas, we said it was the 19% increase. In the United Kingdom, for example, it's only a 3%.
Oh, wow. Oh, that's interesting. Will they really cap lending? Is that a real threat with teeth?
I think so. I mean, I actually do. I mean, look, the banks can hold more capital, but there's always going to be a knockoff effect. And I think writ large, I don't think you're going to see a dramatic impact other than, for lending. But on some of these specific provisions, specifically like consumer loans and mortgages and so forth, even moderate Democrats have been somewhat, they don't say concerned, but they're interested in the issue. And we've seen statements from senators on the Democratic side saying to the Fed, look, we understand what you're doing here, but just make sure that you're going to have your ducks in a row and make sure that everything doesn't harm the underlying consumer here. And I think the Fed has actually taken that back. So the proposal is multi-100-page proposal, but when the regulators do finalize this, and if they finalize it in this year in our scenario, it's going to be dramatically scaled back. And we think that the Fed and the OCC and so forth, because ultimately you're going to need Jerome Powell to finalize this. He needs to approve it. And Jerome Powell has said he's not going to do that unless it's a consensus amongst the board.
Okay, fair enough. On the flip side, isn't there a case to be made for hey guys, hold money in case some of the loans go bad so you don't have to tap into U.S. government taxpayer money?
Oh, yeah, absolutely. I mean, both sides have excellent points. I mean, if you look at the Fed point of view, we had this regional bank turmoil.
Exactly.
We've issued this bank term funding program, which is set to expire in March. And as last time I checked, there were, quite a number of banks that were actually tapping into that. And you have a history of bailing out banks, over the last 10, 15 years. The bank perspective is, well, you've already created all these other rules out there that have protected us. And who's right and who's wrong? They're both right and they're both wrong. And there's a happy medium. It's just, can we get to this happy medium? Well, I'm not exactly sure.
Yeah, but it also wonder if we take into what happened in March with SVB and stuff, that it's the smaller banks and the regional banks that are more of the issue, not the large ones. So in essence, then, are the large ones having to fork over money to make up for the shortcomings of the smaller guys?
Yeah, and it's actually interesting you brought that up, because when the Basel III proposal came out, we actually anticipated, and I think the market anticipated, that this was only going to be applicable for banks that are above $250 billion in assets. So the PNC, the U.S. Bank, the Truist, Capital One, for example. Now, what the regulators did is they said, no. We're going to push this down to the $100 billion level and incorporate these small regionals. Now, that's something that has not happened in the U.S. financial regulatory framework. Even in Dodd-Frank, these large regionals weren't going to be included in the Basel III endgame. Now, the capital hit for these banks are a little bit different. It's much smaller. It's like 2.4 to 4% in increase. But there are other provisions in this Basel III endgame, like what's known as the AOCI and realizing for unrecognized securities and so forth like that, that impact the regional banks more. It's just that the fight and all of the TV commercials that are airing during NFL games and stuff are being led by the big banks.
Right. Yes. And to be fair, though, the regional ones are the ones that are really needed for the small consumers. So it's kind of like a hit or miss on that part. Is a viable strategy just to wait down the clock until November 4th of 2024?
Absolutely. I mean, so let's talk about process. So January 16th was the comment deadline. The comments have all come out, and they were essentially two types of comments. The first comment was, this rule is bad, you need to stop. The other type of comment was, we think you have a serious legal issue here, and we're putting you on notice that we're going to sue you. It's been reported that the Bank Policy Institute, a trade association here in D.C., has retained Eugene Scalia, the former labor secretary under Trump, to do exactly this. And so if the industry has put the Fed on notice that we're going to sue you, the Fed has a challenge. They have to essentially say, right, we have to scale down this proposal to get the moderate Democratic policymakers on board to ensure that these hits to the consumers aren't really there. But at the same time, can we scale it down enough to actually satisfy that APA process that I mentioned earlier? And if not, somebody's going to sue. It will go to the Supreme Court. And the U.S. regulators are losing a lot of cases right now in the Supreme Court because of their new nature.
Oh, that's so interesting. Okay, so this is just one of the many, many things that you're tracking. What are some of the other proposals?
So when you mentioned regional banks, there's another proposal at the Fed that's actually moving along the same time on long-term debt. Now, this is applicable to $100 billion and up. Again, we thought it was for the $250 billion level. It's actually now $100 billion and up. And what this proposal does is that it requires these regional banks to issue long-term debt to safeguard against systemic risk. Now, this proposal is much less controversial, but extremely important. It's less controversial because the regional banks have to issue long-term debt, not what is known as TLAC debt, total loss absorbing capacity debt. If that was the case, and this is something the big banks already do, if that was the case, this was going to be much onerous. So when this proposal came out, we actually looked at this and said, you know what, this isn't all that bad. However, the same APA issues are being thrown out there because, again, they're moving extremely fast. So if you're a debt investor or a credit investor and you like that regional bank, that mid-sized bank issues, you could have somewhere around $120 to $140 billion in new debt to play with over the next 3 years once this is finalized, and we think it will be finalized this year.
What's the difference between TLAC and long-term debt?
Just much less onerous in terms of regulations and requirements and how long you have to hold it and what constitutes that type of debt. A long-term debt definition is actually much more broad. So there are other types of debts you can actually just go out there and purchase and so forth and issue, and it solidifies that definition.
Versus TLAC, which has different requirements.
Correct.
Okay, scratching the surface of this, but I like it. All right, Nathan, thank you so much. Really appreciate it. Nathan Dean, he's Bloomberg Intelligence Senior Government Analyst. That is this week's edition of Bloomberg Intelligence on Bloomberg Radio, providing in-depth research and data on 2,000 companies in 130 industries. And remember, you can access Bloomberg Intelligence through BI Go on the terminal. I'm Alix Steele, and this is Bloomberg.